Today's market moves weren't really about direction. They reflected a deeper shift in how investors are thinking about risk, policy limits, and physical supply constraints. Markets closed higher across the board, but the tone underneath was more complex. Equities advanced modestly, with tech leading, while the S&P 500 and Dow followed behind. At the same time, bond yields moved sharply higher, with the 10-year pushing back toward the mid-4% range. In commodities, oil broke back above the $108 level, reinforcing upward pressure, while gold held near elevated levels after last week's strong move. Volatility stayed firm, still above the key threshold that signals ongoing stress, and the dollar remained relatively flat. So on the surface, this looked like a risk-on day, but under the surface, something more important changed. What really drove today's reaction was a shift in how investors are interpreting both geopolitical risk and policy constraints. The energy story has evolved. This is no longer about temporary disruption to shipping routes. It's now about physical damage to production infrastructure. Recent confirmed attacks on major oil facilities in Saudi Arabia have shifted expectations from a short-term supply interruption to a longer-term production decline. And that changes the timeline completely, from weeks to potentially months or quarters. That's why oil moved higher again. The market is no longer pricing inconvenience, it's pricing lost capacity. At the same time, another pressure point is reemerging: the banking system. New data around regional bank balance sheets showed deeper stress than expected, particularly tied to commercial real estate exposure and losses on bond portfolios. This brings back a familiar constraint. If yields rise too far, the financial system starts to absorb damage, and that creates a policy conflict. On one side, inflation pressure is rising again through energy. On the other, the system may not be able to tolerate tighter financial conditions. That tension is what markets are now trying to price. You could see it in how capital moved. There was a clear rotation into areas tied to real cash flow stability: energy, consumer staples, and parts of financials. Energy, in particular, is acting less like a cyclical trade and more like a structural hedge. Investors are prioritizing businesses that can pass through rising costs and maintain margins in a higher inflation environment. At the same time, flows into defensive assets like gold are starting to stabilize again, suggesting that investors are no longer just reacting to liquidity pressure, they're actively repositioning for risk. But here's where things get more fragile. One risk that isn't fully priced yet is what you could call a secondary supply shock. It's not just about damaged production, it's about what happens next if storage and transport systems reach capacity. If regional export routes remain constrained, production facilities may be forced to shut down wells entirely. And unlike a shipping delay, restarting production is not immediate. It can take weeks. That introduces a different kind of risk, one tied to physical limits, not just market expectations. This raises an important question investors are starting to debate. Is the market still treating this as a temporary disruption, or is it beginning to price a more sustained supply shock? I'd be interested to hear how you see this, whether this risk is already reflected in prices or still underestimated. Stepping back, the broader macro signal is becoming clearer. Markets are increasingly behaving as if we're entering a more unstable stagflation-like environment, where growth is slowing, but inflation pressures remain persistent due to supply-side constraints. And importantly, the assumption that central banks can smoothly manage both sides of that equation is starting to weaken. That's why you're seeing this unusual combination: higher yields, rising oil, resilient equities, and sustained volatility, all at the same time. It's not a clean narrative, it's a conflicted one. Looking ahead, the next phase will likely be shaped by a few key developments. First, any confirmation of production shutdowns in the Middle East would significantly escalate the supply story. Second, further clarity on bank balance sheet stress will determine how much room central banks actually have to respond. And third, upcoming central bank communication will be critical in shaping whether markets lean towards stability support or continued inflation focus. The broader takeaway from today's market reaction is that investors may be reassessing how resilient both the financial system and global supply chains really are under pressure. But markets rarely move on a single narrative, so I'd be interested to hear how you interpret today's signals. If you find this type of calm, analytical breakdown useful, consider subscribing. I share regular briefings focused on the deeper forces shaping market behavior. And as always, thank you for spending a few minutes here today.